Hello financial fans, welcome back to another stock analysis. Today we'll be covering Rio Tinto plc, stock ticker RIO. Rio Tinto is a global mining and metals company that operates in several countries around the world. The company produces a wide range of minerals and metals including iron ore, aluminium, copper, diamonds and uranium. Rio Tinto's operations involve the extraction of these minerals from the ground, as well as the processing and refining of these materials to produce high-quality products that are used in a variety of industries including construction, automotive, aerospace and electronics. The company also has a strong focus on sustainable mining practices and is committed to minimizing its impact on the environment and local communities. Rio Tinto invests in research and development to improve its mining practices and reduce its carbon emissions. In addition to its mining operations, Rio Tinto also has several joint ventures and partnerships with other companies to develop new technologies and products. For example, the company has partnered with Apple to develop more sustainable and ethical methods of producing aluminium, which is used in many of Apple's products. They currently are sitting at a $144.8 billion market cap, and in 2022 they generated a revenue of $55.6 billion, and the dividend yield is currently sitting at 6.88%. 66% of their revenue is generated through iron, 20% through aluminium, 5% from copper and gold, 5% from other minerals, 3% from various other minerals and materials, and 1% from diamonds. To determine the final valuation of the company, we'll be using margin of safety. This margin of safety will be based on the financial ratios, the financial health and the growth of the company. And we'll be using a standard margin of safety of 25%, that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety can increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $13.8 billion in 2013 to $20.5 billion in 2022. The average EBIT growth was 16.9%, meaning a 5% deduction in a margin of safety. The margin has gone up as well over the years, going from almost 27% in 2013 to almost 37% in 2022. The average margin growth was 9.9%, meaning another 5% deduction in a margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up over the years, going from $1.66 a share annually in 2012 to $7.46 a share annually in 2022. The average dividend growth was 23.1%, meaning a 10% deduction in a margin of safety. This with a very high payout ratio, currently sitting at 114%, meaning a 5% increase in a margin of safety. It says deduction, but it's supposed to say increase. Which is of course because they are most likely gonna cut their dividends in the coming year with this high payout ratio. The next two metrics are the debt to EBITDA and the return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it and divide it by the EBITDA. Out of this we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Rio Tinto this is a very small 6% debt to EBITDA ratio, which is a 5% deduction from margin of safety. The return on invested capital for Rio Tinto is sitting at a very solid 16.6% ratio, meaning that the management is very effective at allocating capital. This is a 5% deduction in a margin of safety. Looking very good so far for Rio Tinto. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model of import to free cash flow of Rio Tinto going from 2013 to 2022. The average growth rate in free cash flow annually during this period was 37.2%, and I'm projecting an expected growth rate in free cash flow of 6% annually over the next 10 years. With this percentage, we can determine the future free cash flow of Rio Tinto and determine the terminal year valuation using a perpetual growth rate of 3% and a discount rate of 9%. With this, we get a sum of free cash flow of $188.6 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $185.2 billion. All that's left to do then is to divide it by the amount of shares outstanding, giving us a discounted cash flow price per share of $114.37, which is almost a 66% upside from the current price. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth rate in dividends over these years, has been 36.6%, and I'm projecting an expected growth rate of 3% in dividends over the next years, including that there will be no cuts in dividends, of course. I will be using a discount rate of 9% in this valuation model once again, and this gives us a dividend discount model price per share of $128.06, which is almost at 86% upside from the current price. The third model that we'll be using is the Graham's revised valuation formula. In this model we look at the earnings per share that Rio Tinto is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds, and we go by the theory that the PE of a company with no growth is always at 7. Looking at all of these metrics, we get a fair value of $71.44, which is a 3.68% downside from the current price, or upside rather, from the current price. The next model that we use is the multiple valuation. In this model we look at similar companies to Rio Tinto, look at their stock price and their earnings per share. This way we can determine the average PE multiple in the industry, which in this case is 6.77. All that's left to do then, to get our fair value, is to multiply it by the earnings per share that Rio Tinto is generating, which is $7.62 a share. And this gives us a fair value of $51.59, which is a 25% downside from the current price out of this model. And the final model that we'll be using is the mean reversion theory. In this model we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. The average dividend yield over the past 5 years that we have imported here has been 8.98%, and the current yield is 6.88%, so on this metric it is currently overvalued. The PE ratio of the past 5 years that we have imported has been 8.93, and the current PE ratio is 9.04, meaning that it's slightly more expensive at this metric as well. And this gives us a fair value of $60.42, which is a 12.3% downside out of this model. If you want access to all of my valuation models that I use in my videos, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, the discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $85.18. Our margin of safety we determined earlier, using a standard margin of safety of 25%, deducting by 5% for the debt to EBITDA, 5% for the EBIT growth, 5% for the margin growth, 5% for the return on invested capital, deducting it by 10% for the dividend growth, and adding 5% for the payout ratio, giving us a margin of safety of 0%. This, with the current price of $68.90, is an upside of 23.62% from the current price. So in this case, it would indicate a buy. If there's any other companies that you would like to see me cover in this channel, please let me know in the comments, and thanks for watching.